Okay, let's dive right into this. Welcome to today's explainer. If you've ever felt like your SIPs, your systematic investment plans, are just a little too rigid, or maybe you've been wondering if there's an actual mathematically sound way to grab those market dips without totally losing your discipline, well, you are in the exact right place. Today, we're looking at an absolutely brilliant approach, the RSI plus SIP strategy. We're going to break down exactly how to use the relative strength index, the RSI, to intelligently adjust your investment amounts so you're not just relying on gut feelings anymore.
Here is our roadmap for today. We'll start with the Smart Shopper strategy, which is a super simple analogy to lock in the right mindset. Then we move straight into the hard numbers with the core RSI rules. After that, we'll look at some real-life SIP adjustments, dig into the math behind the power of averaging, and wrap up with common mistakes to avoid.
All right, Section 1, the Smart Shopper strategy. I want to challenge you for a second to think about how you typically behave when you're just out shopping versus how you act as an investor, because usually there is a massive disconnect. Think about this. If your absolute favorite store suddenly puts a huge 50% off sign in the window, do you run away in fear? No way. You probably buy way more, right? You recognize that the items are on sale and you jump on the opportunity. Yet when the stock market goes on sale, when prices literally drop, most people panic and just stop buying altogether. And this brilliantly illustrates the mindset shift we really need to make here. We've got to treat the stock market exactly like retail. When the market is on sale, you buy more. When the market is expensive, you don't panic, and you definitely don't stop. You just buy normally. It's a completely simple concept, but actually doing it, that requires taking emotion out of the driver's seat and replacing it with a solid system. And that system is the combination of SIP and RSI. Your SIP gives you the ultimate discipline. It's the engine that ensures you're consistently investing month after month, completely ignoring the noise. But the RSI, that gives you your timing signals. It tells you exactly when the market is having that big clearance sale. When you combine both, you get vastly smarter investment behavior. You're adjusting intelligently, not emotionally. Which brings us to Section 2, the core RSI rules. So how do we actually know when the market is weak or on sale? We can't just guess, right? Well, here is your playbook. RSI basically measures the speed and change of price movements on a scale, and we can break it down into 5 clear tiers. Let's walk through them. If the RSI drops below 30, the market is oversold. That's a heavy crash. Your action? You aggressively increase your SIP. If the RSI is between 30 and 40, the market is weak. Here, you increase your SIP moderately. Now, if it's sitting between 40 and 60, things are completely normal. You just continue your regular SIP. When the RSI creeps up to 60 or 70, the market is strong. Just stay disciplined, keep the regular SIP going. And finally, if it goes above 70, it's overbought. The market is expensive. Here, you avoid adding any extra money. Just stick strictly to your base plan.
So, the crucial point here, the absolute golden rule of this strategy is this: never stop your SIP. Only adjust, don't interrupt. You probably noticed that even in the overbought or strong categories, the action was never ever to stop investing. The discipline of the SIP is permanent. It's only the amount that flexes based on the opportunity the RSI is showing us.
Let's look at Section 3, real-life SIP adjustments. Now, theory is great, but let's actually apply this to a real portfolio. Let's establish a base monthly SIP amount of 10,000 rupees. This is your anchor. This is the amount you're fully committed to investing during totally normal everyday market conditions. Now, what's really interesting about this slide is seeing how that 10,000 rupees adapts based on the rules we just went over. Look at the 3 bars here. During a normal market, RSI between 40 and 60, you simply invest your base 10,000. During a market peak, RSI above 70, things are expensive. You stay exactly at 10,000, no extra cash. But check out that bar on the left. During a market crash, when the RSI drops below 30, you aggressively increase your SIP to 15,000 or even 20,000 rupees. You are buying the sale. Section 4, the power of averaging.
So why does this specific adjustment strategy actually improve your long-term returns? Well, it acts as a much smarter form of averaging than a regular flat SIP. There's a clear 3-step mechanical advantage here. Step 1, because you dynamically increase your investment amount during a crash, you end up buying significantly more units at much lower prices. Step 2, by loading up on all those cheap units, your overall average cost per unit across your entire portfolio drops much faster than it would normally. And step 3, because your average cost is now lower, when the market inevitably recovers, your long-term returns improve dramatically.
It all boils down to validating that classic piece of wisdom: invest more when others are fearful. That is what smart investing looks like. The RSI gives you a mathematical, unemotional trigger that tells you precisely when that fear is peaking. It lets you step in and buy while everyone else is panicking. RSI points out the opportunity, and your SIP provides the vehicle to actually capture it.
Finally, Section 5, Common Mistakes to Avoid. Look, any powerful tool can backfire if you don't use it right. Here are the major pitfalls to watch out for. First, stopping your SIP when the RSI is high. High RSI just means don't add extra. It does not mean halt your base discipline. Second, trying to perfectly time the market. These RSI levels, like the 30 to 40 zone, they're zones, not magic crystal balls. Don't sweat a single point difference. Third, investing a massive lump sum blindly just because of a signal, without actually considering your portfolio allocation. And fourth, ignoring your long-term goals. Remember, this is a strategy for long-term wealth creation, not short-term trading.
And here is perhaps the most absolutely crucial guardrail of all. You should increase your SIP only when you actually have the surplus cash to do it. Never stretch your daily living finances just to aggressively buy a market dip. Personal financial discipline is always paramount. A great way to prepare is by keeping a little surplus liquidity ready on the side so you can easily deploy it when that RSI flashes below 30.
So, what does this all mean for us? We've seen how treating the market like a retail sale, using RSI to spot those sales, and dynamically adjusting your SIP can drastically lower your average costs and supercharge your long-term returns. It literally takes the guesswork out of buying the dip. So the question is, are you ready to stop investing emotionally and start adjusting your SIP intelligently? It might just be the best upgrade you can make to your financial journey. As always, please remember this explainer is for educational purposes only. Mutual funds are subject to market risks, so definitely consult a qualified professional before making any moves. Thanks so much for hanging out with me on today's explainer, and happy disciplined investing.